Good evening, everyone, and welcome to Admiral Markets webinar. My name is Nenad, and today Chris is with us also. So we will take a look into revenge trading and the 7 cures against revenge trading. So before we begin, as always, our standard disclaimer explains that all education material is developed by Admiral Markets as AS Estonia, and by accepting this risk disclosure statement, you're also proceeding further with us. Admiral Markets UK Ltd will take no responsibility for information accuracy. This is solely my and Chris's opinion, and have in mind that Forex is risky business, so this webinar is for informational and educational purposes only. And you can use Admiral Market Supreme Edition by downloading it into your trader's room. So log in into your trader's room, download Admiral Market Supreme Edition, and if you're thinking about making a new account, you can always do it when time is the best. And today it's the best time because deposit bonus campaign is still on, and as you know, you can use, by trading with Admiral Markets, you can use credits and buy all our custom-made method systems and indicators. Don't forget that Admiral Markets is officially best MT4 broker bar voted in UK. So today's agenda: psychology of a gambling trader, revenge trading, and the cure. So before we begin, I need to say that really a majority of traders suffer from gambling addiction, and I mean literally gambling, because revenge trading is a form of gambling. Gambling trader will definitely try to hold on a position for too long or cut it short as soon as he sees the profit. Usually that will be accompanied by over leveraging or enlarging position size, and very frequently it will be totally true to chasing the markets. Gambling trader will very often succumb to revenge trading and will take trades without any fundamental or technical validity, simply because he or she sees that the market is turning down and that there is potential new opportunity to be made, and okay, let's jump in. Jumping in into a freight train is not good. That wouldn't lead to any long-term success. So whenever you take a trade without any technical validity, think of it as possible revenge trading. Not simply because you might lose a position, but because it's a form of revenge. So you want money, market does not give you any money, and you go for a revenge. It's not always the same. It's not always when you lose your position, you want to double it by taking a reverse position, or you want to make up for the loss. It's not always that case. The case can also be if, let's say that market is ranging and you don't have any setup. You just want to take the money from the market. You don't care about ranging market. You don't care about non-volatility. You just want to take some pips out of it. It's also a form of revenge trading. Of course, that's a second form of revenge trading. And the first form of revenge trading, we will be focused on it today. Also, jumping in a position based on a feeling, simply because market is not going anywhere and you think that it will go up or down, it's also a form of revenge trading. As I say, it does not necessarily mean you want to revenge your position. You just want to make some money out of it because the market is not giving you anything and you want to take a revenge. Well, what happens is you usually lose, right? So revenge trading is definitely poor risk management, because if you really think that you can make up for the loss, every single time you make a trade with double the position size, well, it will lead to poor risk management. But there is a cure, and wait until we get to it. There is a great cure to that. And I personally use the cure if it happens because I'm always within my risk threshold. Also, for example, think about taking 8 trades and 50% of them are losses. And let's say that 1 or 2 of those losses are huge losses. That means that you have either a bad system or you're doing a very, very poor risk management. And what you can do is, and what you should never do is, double, tripling down the position or averaging down into position. So what you should do is keep the risk within risk limit threshold. So let's say, for example, that you have taken 8 trades and 50% of them are in a losses. And let's say that you are minus 2% for the day. And what would you do? So you need to double or triple down your next position in order to go to break even. If you fail to do that, you will be in a loss, and it can be up to minus 10% in a single day. Right? It can happen. So what you should do is, okay, we will get back to it. What I do is usually, I start trading with very low risk. And my usual risk when I start to trade is 0.3 to 0.5%. If I lose this trade, I might go with another position that is 1%. If I lose it, I would be losing only 1.5%. And my risk is 3% per day. So you can do it, but not in a form of revenge. You need to be patient and you need to wait for the right setup. Revenge trading is this. We take a position. We are in a good profit, so we are happy, right? Well, we don't close it. We are greedy, right? Then what happens is we get a beating, stop loss hit, and we are mad. We take another trade leverage to the maximum. We are mad. Mayday call, huge loss, margin call, most of the account wiped. Why? Because guys, it's simply, just think about it. This is not a rocket science. Most of traders who lose heavily would opt for a big position, initial big position. And most traders who lose heavily would probably opt for 5% of a risk for the first trade. So let's say you have $10,000 account, right? And you want to risk, let's say 5% in a single trade. So 10,000 is your account. 10% is 1,000. 5% is 500. So you want to risk 500 euros for the first trade. So that equals to let's say having one lot trade and 50 pip stop loss. Okay, that equals to roughly to 500 euros if pip value is €1 per pip, let's say, just for example. So you want to do this trade, right? So you want to take one lot trade with 50 pip stop loss, and you will be risking 5%, right? Is it smart? What do you think? Is it smart to open on $10,000 account one lot trade with 50 pip stop loss? Well, if you ask me, it's not smart. Why it's not smart? Well, simply because this is your risk, right? 5%. What did I teach you guys? What have I told you so many times? As soon as you cross your 5% of risk threshold, you will be in danger zone. And I mean it. As soon as you cross 5% of risk, your account is in danger. So instead of making the first position 5%, it's much better to use lower risk. So if you risk 1% per first trade, 2% on a third trade, and again 2% on a second trade, and 2% on a third trade, you can make 3 trades with much better risk because you have more chance to recuperate than making your first entry with 5%. Because inevitably it will come to this. Sooner or later, if it's not today, it will be tomorrow. If it's not tomorrow, it will be in few months. If it's not in few months, it will be in 6 months. It doesn't matter. The point is clear and the result is the same. This is your result. This one, or this one, it doesn't matter. Something will happen and you will be mad at you and at your account and at your broker and at your family. When is revenge trading triggered? It's triggered after unexpected loss and also when a great profitable day turns into a red one. So you will be digging deeper into position, you will be making reverse position, and the ultimate point is you will be relying on luck, not on skill. And remember, revenge trading is always driven by a fear of loss. Okay, when you think about it now at this time, somehow you know that it won't happen, right? Because we are talking about it now and, well, you say, okay, I know, Nenad, I know your point, I won't do it. You know your point while I'm teaching you, while I'm lecturing, while I'm presenting you a webinar. As soon as I close this webinar, it will be the same. Tomorrow you will probably do your revenge because you had an unexpected loss, or 2 months later you will completely forget what I told you and you will be again making your revenge trade simply because you think that you can make it up. You think, but you are not sure. You have the fear of a loss. You are completely terrorized by a loss. It's normal. Losses are normal. And whenever you take a loss, think about what I say. You should take a loss from time to time because it's not normal that every single trade goes in a profit. Something is not okay. So whenever you take a loss, think about it, but think rationally. 1% is manageable. 2%, 3% is also manageable. But having a risk of 5 or 10, I know that some traders take a risk of 20% in a single trade. It will be very hard to manage after it hits a stop loss. You don't have enough risk to manage. You will be trading on your margin, guys. It's much better to use lower risk than rise it exponentially, but not in a form of revenge, only in a form of a good setup. Revenge trading is always triggered after unexpected loss. Think about this. You had a profitable position, then suddenly your stop loss was hit. And you take 2 lots now. So let's use previous example. So you had 1 full lot and 50 pips stop loss, and it equals to 500 euros, right? And you lost it. You make another trade by risking 2 lots, and you just need, no, it's you think it's easy, because instead of making 50 pips to make it up because you lost 50 pips, right? You need only 25 pips with 2 lots to make it up for this initial loss. So you only need 25 pips. So let's say that your stop loss is 25 pips and you lose it. What if you lose it? It's another 500 euros. So your account, instead of 10,000, it's now 9,000. It doesn't look good, right? 4 figures, 5 figures. It doesn't look good. You have lost 10% of your account in 2 hours or in a single day. Is it really smart? Is it a way to go? No, guys. This is not a way to go. What you should do is always follow your risk management. There are cures for that, but you need to be ready to accept the cure. You should not rely just on pure luck. You should rely on your skill. Okay? Okay, you should rely on your skill. Look at this now. Again, let's assume that you have taken that loss. So one lot of 50 pip stop loss equals to 500 euros. 2 lots with 25 pip stop loss equals to 500 euros. So you lost 1,000 euros, right? Is it better to trade with 0.3 lots initially or 0.2? Let's say 0.3. So 50 pip stop loss. So if you lose, you will lose 150 euros. Okay, you can still make it up because you only lost 1.5%. Don't go with more than 3% per day. But let's say that your risk margin is obviously 5% because you know that's the top of the risk margin and you will use it. Okay? So another trade can be done with 0.5 lots. So you need to make up 150 euros. So you need only, let's say, like 30 pip. If your stop loss is hit, you will be losing another 150. Guys, you made 2 losses, straight losses in a row. You lost 80 pips, right? 80 pips. Well, if you trade with a good system, it won't happen, definitely. But even if you trade with a bad system, okay, you only lost 3%. It's much better than 10%. Think about it. Now think why I always say your first trade should be with a lower risk. Think why I say when you do trading with me on session recap, why your trade should be within the risk margin. Because sometimes if you lose a trade, you can make it up, but not immediately revenging your trade. You need to wait for the market to come to you and then open a valid trade. Okay? Also, what I notice is that a lot of traders from session recaps are trying to grab every single pip I present on the webinar. Guys, if you see pip pool, it doesn't mean that you need to take every single pip out of the pool. It doesn't mean that you should dry out the pool just to make your pockets deep. I have heard some traders complaining that they took only 40 pips for a trade that was good for 120 pips. Taking 40 pips out of 120 possible pip pool, it's like 30%, guys, 30%. Think about having a vault with gold, with platinum, with dollars, with euros. And what if someone told you, take 30% out of this vault for yourself? Would you take it? Of course you would. But the problem is, some traders are too greedy. Not happy with 40 pips because it's low risk. And instead of taking 40, they want to take 100. And what happens? They didn't protect the trade, and they didn't even put a trade on break even. And instead of at least profit or break even, it's a loss because market will punish it. Well, there is a solution. Instead of trading $1,000 or $10,000 account, open $50,000 account, and if you trade with 1% of risk on $50,000 account, it's still nice money to make. But you cannot expect a good money. I'm not talking about pips now, I'm talking about good money. If you trade $1,000 account, then be focused on pips, because 1% on $1,000 account is not much. 1% on $50,000 each day is good. So the point is, you should definitely think about lowering your risk. And if you lower your risk, it's the same. You will be trading the same on $1,000 and both on $1,000 and $50,000 account. Revenge trading additionally will trigger an emotional response for sure. It will lead to frustration, and it will lead to a spiral of doom that inevitably will end with a margin call. This is your frustration. This is where you should start to trade. This is where you should exit your trade. This is support. This is resistance. As soon as it breaks the support, it becomes bearish. So now I'm talking about the emotional guidance scale in a form of charting, in a form of market, in a form of technical analysis. Going below this point will bring you into spiral of doom. You will be sucked in. In this here, when you find yourself here, you will be starting your negative emotional cycle. And soon you will think about revenge. This is too late. When revenge happens, look how big this vortex is. It will suck you in deeper and deeper until your margin called. So guys, there are cures for that. And I already told you the cures. But still, I need to tell you. The first thing is think about this emotional guidance scale. Think about this. Okay? This is support. This is resistance. You don't want to go below this point, because your emotional trend will start to look bearish. What you do is reduce the risk. Already explained. If you have a good account, keep it. So instead of taking 5% risk on a single trade, that is usually your first trade, try reducing the risk to 1% and follow the rules and recognize when it happens. Because you will know when you will start to think about revenge trading. You will recognize it. Think about yourself and your family and step away, guys. When you step away, you will be patiently waiting for another setup. So let's say that you have lost a trade during London session. Okay, you lost it in the first hour of the London session. You step away and you just need to come back after 2 hours. You still have the time to recuperate. On the third hour, you should come in and see if there is an opportunity to trade. If there is an opportunity, use it. And use the risk how I explained. Okay? Use the risk how I explained. So the point is, don't revenge your trade. Be patient. Be patient and definitely come later and try to trade it. If you see an opportunity, grab it. But not just by reversing your position. So it looks like this. You lost your trade in London session. Immediately as you lost your trade, you double your position and go with the trade. Don't do it. You lost your trade in London session, step away, come in 1 hour or 2 hours later and wait for another setup. You will still have enough of the risk to go with, because initially you reduced the risk. Initially you reduced the risk. So instead of risking 10%, you are risking now only 3% or 2 or 3 or 4% total. Even if you reduce the risk further, you can make 3 trades in a row with only 3% of a risk per day. And you will still be able to recuperate any loss you had if you play within risk boundaries. Guys, Forex trading is about tripod of successful trading. But most important leg is your risk management. You need to have a good system, because if you have a system that it gives you streak of losses, then don't trade it. You need to switch. If you have a system that is 70% profitable, by using this, what we are teaching you, you will be able to trade successfully. Let the market come to you. And always think, guys, think about building an account or wiping it out. Because if you think about your own account, you will probably be much more wary about your own self, yourself, and your family. Because the more you think about this, the more careful you will become. And finally, what I will say, and then Chris will resume, trade in the zone, guys. Align your emotions with price. What it means is align your emotions here with price. Think about this as a form of chart. If you started to trade here, think about your emotions. If you made money, exit here. When you are very excited, when you're joyful, when you think that you are unbeatable, exit the market, or at least protect your trade. Watch the price and watch your own emotions. Because if you fail to do that, I'm 100% sure that in a short amount of time, you will be sucked into a spiral of doom and you will be margin called. So don't let it happen. I hope that you enjoyed my part of presentation. So any questions, we'll be glad to answer. I will share the webinar now with Chris, so he might continue. And guys, if you have any doubts about your trading, if anything is not clear, don't hesitate to contact us. Ask whatever is not clear. Cheers, and I'll talk to you soon.
Thanks, Mehdi. Great stuff. Let me see if I can share my screen. I hope that everyone hears me first of all. Let me do that a quick sound test. If you could confirm that through the chat, that would be great. And perhaps also the screen in the meantime. All right, so quick sound test and screen test, and I'll continue with my part looking at curating revenge trading. That was talking about aligning our emotions with price, and that's an interesting comment and observation. I think that's difficult to do when you just start out, but the more one trades, the more sense that starts to make. All right, so can I have a quick confirmation that someone is hearing me?
All is good. Everyone can hear you, Chris.
Yeah?
Excellent sound.
Great. Perfect. Alrighty, so great, thanks, Nana. So let's take a look at the first step. We are looking at, I think, a very important step is just building the skills for technical analysis. Because I think that as we learn to understand the market structure, price movements, certain momentum, trends, reversals come less as a surprise. I think the more we understand what's going on with the market, the patterns it makes, what does that mean, the levels it needs to break, just understanding of looking at the market, the price, and seeing it as a map, right, a roadmap. And when you are in scouting or if you use roadmaps on your GPS, the more you understand, the more you can interpret the map, the more secure one feels with finding your destination, right? Whatever maps or charts you use, the more you know about the map or chart, the more you're just secure in how to use it, and you're not second guessing yourself, you're not wondering how to use it. Now the same is just absolutely valid with price charts in Forex or other financial instruments. The more you understand how to interpret it and how to read it, the better you're going to feel with using that information. So it's a skill like anything else. It takes time. You got to develop it, test it, improve it, build that experience so that you just live it and breathe it in a way. That's the best. Now, if you don't have that time, you still want to put as much time in as you can so that you build that experience as much as you can, right? When you have that experience, you get to a level where you're more in sync with the market, as Ned was saying at the end, and it's just a different cup of tea than when you're looking at it and wondering how to use this, how to interpret that. I use 3 key elements: support and resistance, right? That could be pivot points, it could be Fibonacci, tops and bottoms. I use patterns, candlestick patterns, chart patterns. I use trend and momentum, moving averages, trend lines as well on channels. So I use these 3 topics, right, to dissect the chart, make a roadmap, and understand what's going on. So when I do that, basically I'm analyzing what price will probably be doing. What is the path of least resistance? I talked about it in the past already, and price follows that flow of least resistance. It's the same, mentioned that before, water or a river, as it goes through the landscape, it's going to choose the easiest path, the one that has the least resistance. The same is for price. My job is to analyze that path and find the spots on the chart that I think are worth trading by looking at what is the reward to risk. Where can I put the stop loss and where is the most likely target when I look at trend, momentum, support and resistance, and patterns. Based on those 3 things, right? Let's group them in 3 things: trend, support and resistance, and patterns. Based on those 3 things, which setups have a good R2R? Which setups do I think have a strong confidence so that the win percentage could be on the higher side? So not only am I analyzing the path, but then I'm also trying to find the spots and areas that make the best setups and have the most sense. When I do find those zones, I call them decision zones, right? They're the areas where I want price to get to before trading. Ned also mentioned it, that he's waiting for price to get to let price come to him. So he wants price to go to his levels or go to his decision spots. So that's what I want to say is I want to have already determined beforehand where are those zones. Then I want to know how I want to trade those zones. When price gets to 110, am I looking for shorts when it bounces, or am I looking for longs when it breaks, or both perhaps? What do I do when price gets in that area? What am I looking for? And what trigger would be good enough for me to take that trade? Then once it gets there, then it's the time to react and implement. And that's not the moment when I want to overthink and rethink and reanalyze. Because in that case, it's too late. If price is in my zone and I start to doubt myself, it's kind of too late. Because then there's time pressure, and before I know it, I'm too late with entering, and then I'm mad at myself because I didn't follow my plan. No. That's not good. I don't want that kind of self-intervening thoughts. It's just going to mess up my psychology. That's not what I want. I want determined decision zones, want to pre-plan my idea when price gets there, what do I do? And when it does that, I want to execute that. I want to implement that. That's not to say that once I have a trade idea, a trade plan, that I never can change that. No, certainly I can change that. As long as I always pre-plan the idea, that's fine. But if I start to pre-plan it the very, very last second, that's actually just a very impulsive kind of fear-based reaction. That often can lead to a lot of complications. As long as we pre-plan the idea, a decent time ahead and change it perhaps even a decent time ahead of time, or a decent amount of time beforehand, that's fine. Too late, we just get nervous, just gets messy. We want to, once it gets there, we're kind of like, we're just really, how do you say it? It's a reaction. It's not something, we're not in an analytical mode, right? We're not analyzing anymore. We're just really waiting for price to do whatever we want. Let's say I'm waiting for a bearish price action or a bearish candlestick pattern once it hits 110 on the euro dollar, and then I'll take the trade. That's all I'm waiting for, right? Or how about I'm waiting for a bearish reaction on the 1 hour chart, but on the 50-minute chart, I'll dive into the 50-minute chart because there I want to see the break of the first support fractal, right? So as soon as I see the engulfing twins, I dive into the 50-minute, and then I put the pending order if I have the fractal. So I'm only reacting, only following steps. All right. Now, why do I say that? Is because I think that if we've put time into it, and if we put thought into it, and we've determined the zones, we're less likely to revenge trade. Revenge trading is often impulsive, it's often without thought, it's often without plan. So obviously if we plan, there's a good chance that that trade is not a revenge trade. All right? So third step, so once we build that experience with technical analysis of, let's say, reading the market structure, once I think we have a better idea of approaching a plan, a trading plan, then it's also about being confident when implementing that trading plan, right? So step one is building experience, because without the experience, it's difficult. You know, you can try as much as you can, of course, to convey that confidence, but it's a lot easier if you build that confidence, right? So that will take some time. Then we implemented the plan. We know how to implement it, but then also there's just a general kind of information about the right balance of being confident. We're going to have ups and downs. We're going to have these swings where we're too confident, where we're underconfident, and both are in fact dangerous. Underconfident can have a lot of effects. Closing, for instance, the trade too early, as I write here on the left. Closing trades too early, and then re-entering perhaps. You know, lack of confidence could make us not take the trade. It could make us hedge the trade unwantedly. It could make us take multiple trades because we're thinking that we want to somehow hedge it, or manage that risk somehow in a different way than perhaps is desirable. Now, if we're overconfident, also very dangerous, because then we think we're the king of the mountain, and we're going to maybe take too many trades and enter too many times and do all kind of funny business that we might not want. Entering and exiting multiple times way too quickly. Not part of the trading plan at all. And also about having the attitude, the third column, right? I'm right, market wrong. So often we see that, and it's just not about that. It's only about it's not only about profitability, it's really about consistent long-term profitability. Knowing, of course, when I say consistent long-term, I'm not talking about neatly earning, an X amount per month, let's say, I don't know, 2,000 per month, right? It's not about making it so neatly averaging. I'm not talking about that. I'm just talking about implementing our trading plan with consistency and discipline so that our outcome is optimized over the long term. And there's going to be variances, obviously, right? There's going to be ups and downs, even if we have an attitude where we're not treating the market as something that is wrong and we're right. If we have that attitude, yeah, I'm scared that there's going to be more danger for overtrading. All of that, of course, is helped, again, by more backtesting and knowing and accepting what our drawdown could be. Drawdowns, I think, is one of the most difficult parts of it, and it's very complicated. It has a big impact on psychology. Not only, is one trade important. That's often enough the first battle we encounter, right? Can I handle just managing that trade without getting nervous? Once we do that, great. But then the next step we're going to bump into is just having 3 losses, 8 losses, 5 losses, and 3 break-even trades. How do you deal with that? Especially if you have higher risk, or even if you have lower risk, it's something that you feel uncomfortable with. So that's really important as well, because if you get into that spiral where you're thinking, oh, I really need a win, kind of leads to revenge trading, because we let's just say 10, just for the fun of it, 10 losses in a row, and we're down, I don't know, 7%, and feel that we need that win this week. There is really not a setup available, but we still take a trade. That's not necessarily revenge trading one setup. There's not one particular setup that made us mad, but the whole series kind of annoyed us. And that kind of forced us to take a trade. Same thing, still revenge trading. So it's important to realize that if we do that, we're just exaggerating the losses, the drawdown, because let's say we make it -7, we go to -10. Then, hopefully, we get a bit of a comeback, and before we know it, we're only down 2%, right? But if we would have not lost our cool during that drawdown, it would not have been down 2%, but we would already be at break-even or even up 1%, because we over-risked during that phase. all of these kind of emotions can make things just more difficult, basically, right? So let's talk about this side. There are a lot of balloons here. So let's start with the left upper corner. I kind of hinted a bit just a second ago to that. Don't enter without a good cause. So I look at these three elements, right? Trend, support, resistance, patterns. If you're down 7% and there's that urge to kind of improve that situation, and we take a trade even though there's not a trade, we're breaking a rule. We're entering without a good cause. Also, same thing is holding on to trades. Trade might look good at the beginning, but several hours down the road, we just doesn't look as good. We have, of course, we want to have that in our trading plan. It's not like we're trading the 4-hour chart and 3 hours later the trade doesn't look good anymore. That's actually impossible because we should be looking, not at the 5-minute chart for a 4-hour trade, right? Or unless you did a lot of research on it. Who knows? I don't want to exclude anything necessarily, but I mean, that would be very weird if you get my drift. So probably not. So I think that we have to give patience to the trade at the start, but then there are times that we have to be less patient. And I talked about that in the Trade Management webinar. I'm not going to dive into that again. You can find it on YouTube. Just go to Admiral Markets on YouTube and you'll find the channel of Admiral Markets with a lot more webinars. So we don't want to hold on irrationally either. So we want to pick our trade with caution, but we don't want to feel married to it, basically, just to complete that row. There are all kinds of emotions that could be popping up, like we want to avoid correcting past mistakes, for instance, as well. That could be another reason for revenge trading. So what kind of solutions do we have? Well, we want to have discipline and focus because these two kind of lead to self-awareness. If we have these two things, discipline and focus, I think that we could, there's that potential to really focus, there's a potential to really build on a consistent equity curve. And it does take that focus and discipline to manage that equity curve. Because 1 second, one trade, one moment of weakness, and boom, we lose our composure, forget it. Perhaps we just, the equity curve is, forget it, it's totally wrecked, or big drawdown, and it really doesn't take much to lose all of that hard work within a day. I think that is always so risky when trading. It's like so much effort into building, such an effort to get into a good run, and boom, gone. I've had that. Everyone had that, most likely, unless you just started, right? It's impossible not to have it, and it just takes time to really stamp that out and be so bent, so focused on making sure that we live to trade another day, another trading day. And it might seem like a stupid goal, but in reality, it is the first goal, to make sure that we can trade tomorrow or the day after tomorrow. All right. So then I talked about rules as well. We want to follow our rules, print them out, check them regularly, check them before we trade. Sorry, we want to really totally be those rules of our trading. We want to dream about them almost, right? It's something that if we don't dream about them, we really want to have it clearly envisioned on paper. We want to give us all kind of helps and clues. We want to make it easy for ourselves when trading, that we, execute as much as we can properly. Preferably everything, but obviously we want to make it as easy for us to do that. Now, if you're making any exceptions at any point in time, I'm not saying that it's entirely impossible. There could be some events going on, news events, stuff like that. But you want to be very careful with that. Often enough, making exceptions is not a good sign. So there is a red flag, there is a red alert. Make sure that think about why you're thinking about doing that. Is there any greed or feeling of missing out? Or does the last trade impact how you view the new trade? All of that those are not good reasons, right? Not good. All right. So reviewing those rules, good step to making sure that we're not revenge trading. Revenge trading, I think, ultimately, when we look at, as I said, when we look at building up the equity curve and then boom, losing a large part of that, if we look at the cause of why that loss happened, so much of a loss relative to the gains, such a big drawdown, maybe in such a short time, at the heart of it, it's often over-risking, revenge trading, or both. So to escape those, as I call it here, emotional chains, the market is emotional, right? But doesn't mean that we should. It's going to be difficult to get rid of all emotions. We are human beings, right? So, but obviously, the market is emotional. That's why there's the opportunity to make gains. It also means that if we are emotional, that we might go with the market emotions, and we're losing our edge in a way, to a certain degree, because there's nothing different. If we see the market rising and we get emotional, we think we should join the market right then, right there. No, not that good often. So most of the time, so we want to capitalize, and that's why we want to be very conscious in monitoring our emotional state, and we want to stay balanced. We want to basically not let emotions sway us to respond in an emotional way. We're always going to have some emotions involved, but we want to, in a way, not remove is maybe a stupid word because you can't really remove it all, but we want to balance it, maybe is a better word. Balance it as much as we can through our trading plan, through our experience, and if that's not enough and we feel that we're losing that, we want to take breaks and really walk away and even stop. We want to have kind of like, short circuits. I'm not a big electricity, I don't know anything maybe about it, but I know that if the electricity circuit is not functioning, there's some breaker or something like that, right? It kind of like stops the circuit, right? Something like that. It just doesn't allow it to continue. So that's what we want in trading too. We don't want to get to a point where we overload the system, our own system, and we fuse out, right? So we want to stop that from happening at the correct time. So that's why we want to monitor ourselves as well. Now, last but not least, a bit of a bias here perhaps, but obviously, Algo Markets, I think that you can find a lot of help there. Webinars, analytics, fundamental, technical, wave analysis, all of it you can find there. Heat maps, what name it, blogs, you got it all there. Let's take a look actually live right now. We can take a look. You can see here next week we've got webinars. Now next week a bit less than usual because we don't have this Pro Learning Lab next week on Thursday. The next one is 2 weeks from now. In May, we're kind of back into full action. This week and next week, I have less webinars than usual. But May, we're back in full swing. So, but anyhow, regarding the website, of course, you can find all kind of information here regarding trading platforms, administrator for Supreme Edition, market sentiment, and perhaps most importantly, the 50% bonus, of course, that's valid April, May, when you, as a new trader, or as an existing trader with Admiral Markets, decide to add a deposit bonus in, if you decide to add capital, and then you'll get that deposit bonus. All right, if there are any questions, of course, feel free. You can find the webinar. You would have to go to YouTube, youtube.com. Let me pull that up then, otherwise maybe if we can find it, if it doesn't take too long. It's giving a bit of a headache here, but good. So let me go to that. So you go to youtube.com, and it might take a day or two before it's uploaded. Then on the search, you want to click on Admiral Markets. Then you want to click on Admiral Markets. Let's see, I will share it now. There we go. So this is Admiral Markets. You can see the most recent videos here, but if you just click on videos, there you go. Those are the newest videos. But you can also go to playlists, and you'll see, related kind of grouped together. For instance, Price Action Trading School. You'll see Forex Strategy, Live Trading Lab, but there are more lists, 13 of them. You would need to go, if you want to see more of those educational webinars, to Pro Learning Lab. There are almost 70 now. So there are really a ton of videos. So I think that you will be able to find many of them that you would like to see, probably. All right. So, well, folks, thanks so much for joining. We're going to be looking forward to see you next week again. Of course, tomorrow's still wave analysis, maybe some other analysis as well. Otherwise, wish you good trading, and see you soon. Cheers, everyone.